I want you to take a second and just try to imagine two completely unrelated events happening on like opposite sides of the world right now.
Okay, I'm tracking.
Right. So on one hand, you have these rising military tensions in the Middle East, right? Like effectively altering the path of global oil tankers and, completely rewriting the math on shipping routes.
Yeah, a massive logistical headache.
Exactly. And then on the other hand, somewhere in like a super sleek corporate office in Silicon Valley, a tech CEO just approved the construction of a massive new data center.
To train the next generation of AI models, I'm assuming.
You got it. And on the surface, a geopolitical conflict and the explosive growth of AI, they seem like they belong in entirely different conversations.
Oh, absolutely. They're usually handled by completely different analysts on Wall Street.
Right.
But the underlying thread connecting, a blocked shipping lane and a brand new server farm is this sudden, almost desperate demand for physical terrestrial infrastructure. Both of those events are just aggressively supercharging the actual nuts and bolts foundation of North America. Like, we are talking about the heavy steel pipelines, the massive subterranean storage caverns, and, the sprawling wind farms operated by legacy energy giants.
Well, welcome to this deep dive, because today we are cracking open a highly detailed corporate document that sits right at the intersection of those two massive global trends.
It's a fascinating one, too.
Yeah, we are looking at the transcript from the Enbridge Inc. Q1 2026 earnings conference call. That's dated May 8th, 2026. And as hosts of Talk Tickers, you know our style. We are all about breaking down these corporate earnings calls specifically for retail investors.
Right, taking the Wall Street jargon and making it actually actionable.
Exactly. We want to be data forward, use plain language, and give you the bottom line on what this means if you're holding or considering the stock.
And just to set the table for why an earnings call transcript is so incredibly valuable for us to analyze, we have to look at the format itself, right?
Yeah, it's not a press release.
No, not at all. An earnings call is heavily regulated. The executives speaking on these calls are legally bound by securities law to give an accurate picture of their business.
Which means no marketing spin. Or at least less of it.
Exactly. You get to look past the marketing departments. It forces a level of candor about where capital is actually flowing.
Right.
So we're going to sift through the Wall Street shorthand, the actual financial metrics, and the analyst Q&A to uncover why Enbridge's CEO, Greg Ebel, described the current macro environment as offering the best growth opportunities he's seen in 10 to 15 years.
Which is a huge statement. And just to give you a sense of the sheer scale we are talking about with Enbridge, they aren't just a participant in the energy market.
No, they're the circulatory system of it.
Literally. They touch roughly 20% of all the natural gas consumed in North America. 20%.
That's staggering.
And they handle roughly 25% of all U.S. crude exports. So when a company that massive size alters its capital allocation, it physically reshapes the continent.
And that scale is exactly why their earnings call is basically a window into the broader economy.
Yeah.
They aren't just guessing about macroeconomic trends. They are allocating literal billions of dollars based on hard data regarding where the world is heading over the next decade.
So whether you are an energy investor tracking sector rotation, or you're just, intensely curious about how the virtual cloud actually gets powered in the real world, our goal today is to connect those invisible macroeconomic dots to the literal physical grid.
And the biggest macro dot hanging over this entire Q1 earnings call was the global geopolitical environment.
Right, the Middle East.
Yeah, the transcript repeatedly references the ongoing conflict involving Iran and the closure of the Strait of Hormuz. And we have to look at the mechanics of how that overseas friction translates directly into North American infrastructure strategy.
Because geography pretty much dictates the market here. The Strait of Hormuz is a narrow choke point right between the Persian Gulf and the Gulf of Oman. Historically, roughly 20% of the world's total global oil consumption passes through that single 21-mile wide waterway.
Which is just terrifying from a logistics standpoint.
It really is. When that artery is compromised by military conflict, the global supply chain doesn't just, pause.
No, it violently reroutes.
Right. So what does that look like mechanically?
Well, the immediate result is a massive premium placed on North American energy security. Global buyers, like refineries in Europe and Asia, they suddenly place a much, much higher value on energy that doesn't have to transit a literal war zone to reach their ports.
Makes sense. The risk calculus just changes overnight.
Exactly. The cost of insurance for tankers spikes, the transit times double because ships are sailing around entire continents just to avoid the conflict, so buyers start looking for safe harbors.
And there was a really specific data point in the Q&A section of the call that quantified this shift perfectly for investors.
Yes, the price floor.
Right. One of the executives noted a structural change in global oil-based prices. For years, the industry basically operated on an expected price floor of maybe $65 to $70 a barrel.
Right, that was a comfort zone.
But because of these sustained geopolitical tensions, the market has essentially accepted a new perceived floor of $75 to $80 per barrel.
And that $10 shift in the floor, it radically alters the fundamental math for every single oil producer in places like the Permian Basin in Texas or the oil sands up in Alberta.
How so? Like, break that down for the retail guy.
Well, oil production is an incredibly capital-intensive business.
Yeah.
It has massive upfront costs. When the perceived price floor rises by $10 and stays there, producers gain the long-term confidence to deploy more drilling rigs.
Because they know they'll make their money back.
Exactly. They expand their capital budgets and they pump significantly more volume out of the ground.
But all of that new volume pulled out of the ground is completely useless unless it has a physical path to market.
Which brings us right back to Enbridge.
Right, bringing us to how Enbridge translates that macro chaos into actual financial stability. So let's look at the headline numbers, the Q1 2026 financial baseline.
Okay, let's get into the data.
They reported that their adjusted EBITDA remained pretty much consistent year over year. Their distributable cash flow, or DCF per share, actually rose by 3 cents.
Good sign.
But their earnings per share, their EPS, dropped by about 5 cents compared to Q1 of 2025.
And we really have to translate that financial shorthand for our listeners because normally a drop in earnings per share triggers a massive sell-off for a standard tech or retail company.
Right. Wall Street usually hates an EPS miss.
Exactly. But the underlying mechanics of a midstream energy company like Enbridge, it's just a very different beast.
Yeah. The best way I like to visualize Enbridge's financial model is to think of them as the operator of a massive, highly regulated toll road system.
That's the perfect analogy.
Right. Like they are not wildcatters. They do not bet their own money on whether the oil flowing through their pipes is trading at $60 or $100 a barrel.
They don't care about the price of the cars on the highway, just that the cars keep coming.
Exactly. They collect a steady, volume-based toll for the traffic passing through their lanes, and that's protected by long-term take-or-pay contracts.
And that toll road model is exactly why distributable cash flow is a much more accurate metric for their health than earnings per share.
Break that down. Why is DCF better?
Well, EPS includes massive non-cash deductions, right? Specifically depreciation. Enbridge owns literal billions of dollars of steel pipe buried in the dirt.
Right.
And standard accounting rules require them to depreciate the value of that steel every single year. That heavily drags down their net income on paper.
Even though the pipeline's working perfectly fine.
Exactly. It's a phantom charge. But distributable cash flow strips out that phantom depreciation. It measures the actual hard cash the business generated that quarter, which, as you noted, actually went up by 3 cents a share.
Right. So the underlying business is actually generating more cash. And that 5-cent drop in EPS was also driven by some really specific accounting comparables from the previous year. Right. It wasn't operational decay.
No, not at all. In Q1 of 2025, Enbridge received a favorable legal settlement that sort of temporarily inflated that quarter's numbers.
Oh, one time thought.
Yeah. And they also benefited from investment tax credits related to the Fox Squirrel solar project last year, which obviously did not recur in Q1 of 2026.
Okay, so stripping out the one-off items, the core engine is humming. But the transcript also highlighted a pretty massive currency hurdle.
Oh yeah, the FX impact.
Right, because Enbridge is headquartered in Calgary, Canada. Right. So they're calculating their dividends and reporting in Canadian dollars.
Yeah.
But a huge portion of their actual operations and revenue generation happens in the United States.
Which exposes them to exchange rate volatility.
Good time. There was a 7-cent year-over-year drop in the Canadian dollar relative to the US dollar exchange rate.
That's significant.
For a company moving billions of dollars across the border, that is a severe headwind.
But this is where management showed their strength. Chief Financial Officer Pat Murray explained that their hedging strategy basically insulated their core EBITDA from that currency drop.
Right. They buy insurance.
Essentially, yeah.
Yeah.
They utilize forward contracts and financial derivatives to lock in exchange rates years in advance. They buy financial insurance against the exchange rate dropping, and that insurance paid off beautifully this quarter, keeping their cash flows totally predictable.
And we actually saw a really similar insulation strategy regarding weather impacts.
The Ontario situation.
Yeah, the Q&A revealed that Ontario experienced a significantly warmer first quarter than historical averages.
Which sounds nice for the residents, but bad for a gas utility.
Exactly. For Enbridge's gas distribution business in that province, warmer weather means people's furnaces aren't kicking on. That resulted in a straight-up $10 million headwind.
Ouch.
But, and this is why you hold a diversified stock like this, the diversified nature of their assets absorbed the blow completely.
Because of the storage and interruptible services, right?
Yep. That $10 million loss in Ontario was completely offset by outperformance at their Aitken Creek storage facility in British Columbia and by their interruptible gas services.
Explain the interruptible gas thing, because that's super interesting.
So, when you offer interruptible service, you agree to supply natural gas to a big industrial customer at a discount. But the catch is, you have the caveat that you can cut them off if residential demand spikes during a freeze.
Okay, so the residents get priority.
Always. But when the weather is mild, like it was, you have excess capacity in the pipes, so you sell it on the spot market to those interruptible customers. They turned a weather anomaly that hurt them in one area into a revenue opportunity somewhere else in the system.
That is just brilliant operational flexibility. And taking all of that into account, the geopolitical shifts, the currency drops, the unseasonable weather, Enbridge completely reaffirmed their 2026 financial guidance.
And not just 2026.
Right. More importantly, they projected a 5% average annual growth rate for their EBITDA, their DCF, and their EPS straight through to the end of the decade in 2030.
5% compound annual growth for a company this size through 2030. That is a very strong signal. But that aggressive growth projection did prompt the analysts on the call to press them on their leverage.
Yeah, debt is always the elephant in the room with midstream companies.
Enbridge targets a debt-to-EBITDA ratio of 4.5 to 5.0 times. And currently, they are sitting right at the absolute ceiling of that range.
Right, at 5.0.
Yeah. And for most capital-intensive businesses, maxing out your targeted debt limit heading into what is essentially still a high interest rate environment, that's a massive red flag for a retail investor.
It definitely sounds scary, but the CFO's response was really focused on the mechanical timing of their capital expenditures.
Oh, so?
So they are heavily front-loading their investments. They are deploying billions of dollars right now to build massive infrastructure projects. So the debt is incurred immediately, pushing their ratio to the ceiling. However, those specific projects are scheduled to enter service and start generating significant toll revenues later in the year.
Ah, I see.
Once those new cash flows actually hit the ledger, the denominator of that ratio, the EBITDA, expands. And that naturally pulls the leverage back down toward the middle of their target range.
So it's an accounting timing mismatch. You take out the mortgage today, but the renter doesn't move in and start paying until November.
Exactly. Perfect analogy.
Okay, so having established that financial baseline, let's get into the actual steel in the ground. Let's start with their absolute largest physical toll road, which is the liquids pipeline segment.
The heavy crude division.
Yes. This division moves heavy crude out of the Western Canadian Sedimentary Basin all the way down to the refineries in the U.S. Midwest and the Gulf Coast. And the volumes they reported for Q1 were record-breaking.
3.2 million barrels per day.
3.2 million barrels per day on their mainline system.
Just to conceptualize 3.2 million barrels a day, you have to picture a continuous, high-pressure river of oil moving across the entire continent, 24 hours a day.
A river of steel.
Yeah. And despite hitting record capacity, their primary focus in this segment right now is pushing even more volume through that exact same system.
Right. They are advancing a project called MLO2. That stands for Mainline Optimization Phase 2. And the goal there is to add an incremental 250,000 barrels per day of capacity out of Western Canada by the end of 2028.
And this is where the engineering reality really collides with the regulatory environment.
Because building pipelines right now is nearly impossible.
Right. We live in an era where proposing a brand new greenfield fossil fuel pipeline across North America, it practically guarantees a decade of environmental litigation.
Protests, permitting gridlock, massive cost overruns.
Exactly. So trying to build capacity for another 250,000 barrels a day sounds like an invitation for a regulatory nightmare.
But they're not building a new pipeline.
No. And that regulatory gridlock is precisely why the executive team highlighted their, quote, inside the fence strategy.
Right.
MLO2 is incredibly capital efficient and permit light because it avoids acquiring new land or invoking eminent domain.
So they aren't digging thousands of miles of new trenches across virgin landscapes.
Exactly. They are aggressively optimizing the pipeline corridors they already legally own and operate inside the fence.
But wait, the mechanics of how you shove 250,000 more barrels through a pipe that is already completely full, that is fascinating. Like, you can't just turn up a dial.
No, you can't just wish it through. They are upgrading the massive centrifugal pumps at their existing compressor stations. They're swapping out older motors for highly efficient variable frequency drives that can just handle much higher pressures.
But it's not just mechanical, right? It's chemical.
Yeah, this is the coolest part. They are heavily utilizing chemical engineering, specifically what they call drag-reducing agents, or DRAs.
Okay, what is a DRA?
They're basically long-chain hydrocarbon polymers that are injected directly into the crude oil as it flows.
Like a chemical lubricant.
Sort of. So the fluid dynamics of it are brilliant. When crude oil flows through a steel pipe at high velocity, the friction against the pipe walls creates turbulent flow.
Right, like rapids in a river.
Essentially microscopic whirlpools and eddies that resist the forward momentum of the oil. It requires massive amounts of energy to push past that turbulence.
Okay.
But when you inject these long-chain polymers, they act like molecular shock absorbers. They dampen the turbulent eddies and promote what's called laminar flow, where the oil glides smoothly in parallel layers.
Wow. So just by altering the physics of the fluid itself, you can push vastly more volume through the exact same diameter of pipe without legally increasing the mechanical pressure limits.
Exactly. And that chemical and mechanical optimization creates a formidable strategic moat for Enbridge.
Because nobody else can replicate it easily.
Right. During the call, the executives subtly contrasted their inside-the-fence approach with the absolute nightmares faced by entirely new pipeline builds.
Like the Trans Mountain expansion in Canada.
Or the proposed Prairie Connector. Those greenfield projects require billions in upfront capital and face immense construction risks. Enbridge's advantage is that the pipe is already buried. They just need to deploy advanced engineering to make it work harder.
It's such a smart capital allocation play. But getting the oil out of Canada and the Midwest is really only half the equation here.
The other half is getting it to the global market.
Which brings us to their export super system down on the U.S. Gulf Coast. They recently completed the expansion of the Gray Oak Pipeline. That moves crude from the Permian Basin in West Texas down to the coast, and they pushed its capacity to over 1 million barrels per day.
Huge. And that pipeline feeds directly into their Ingleside Energy Center near Corpus Christi, Texas.
Right.
They just expanded the storage capacity at Ingleside to approximately 20 million barrels. It is now the largest crude oil storage and export terminal by volume in the entire United States.
20 million barrels sitting on the coast.
And they've designed the terminal specifically to load very large crude carriers, or VLCCs.
Okay, VLCC. What does that actually look like?
These are the massive quarter-mile long ships, literally the size of the Empire State Building laid on its side.
Insane.
And you need ships that big to make the economics of exporting oil all the way to Asia actually viable.
And Enbridge now handles roughly 25% of all U.S. crude exports. So tying this back to our opening discussion about the Middle East, the timing of this Gulf Coast expansion aligns perfectly with the macroeconomic chaos right now.
Perfectly. The transcript explicitly noted that because of the conflict and the ongoing closure of the Strait of Hormuz, inbound inquiries from international customers who are desperate for export capacity at Ingleside, those inquiries skyrocketed throughout April, May, and June of 2026.
Because global buyers are looking at a map of the world's oil reserves, calculating the geopolitical risk of the Middle East, and making the strategic decision that they want their crude originating from the absolute safety of the Texas coastline.
Yeah, they want stability above all else.
But that surge in international demand introduces a very specific domestic political risk that we have to talk about.
The export ban question.
Exactly. One of the analysts on the call questioned the threat of U.S. government intervention. With inflation and the cost of gasoline remaining a highly sensitive issue for everyday American consumers, the analyst asked about the probability of the government capping or entirely banning oil exports.
Right, to force that crude to stay domestic,
Yeah.
theoretically lowering the price at the pump.
Now, obviously, we are completely impartial here. We don't take sides on the politics of gas prices. But how did management address that risk?
The management team addressed it by pointing to recent explicit statements from the U.S. Secretary of Energy. On at least 2 occasions recently, the Secretary confirmed that an export ban is simply not under consideration.
Okay.
The broader context here is that the administration increasingly views energy exports as a vital geopolitical tool.
Soft power.
Exactly. Supplying allied nations in Europe and Asia with secure energy is a massive projection of soft power. It decreases their reliance on hostile or unstable nations.
So consequently, Enbridge feels very confident that the regulatory environment will continue to support their export operations.
They're betting billions on it.
All right, so we have spent a lot of time on the legacy liquid fuels destined for the global market. But I want to pivot to the invisible fuel that is quietly holding the entire domestic power grid together.
Natural gas.
Natural gas. And specifically, we need to examine what's being called the Great Storage Squeeze.
Oh, this is such a big deal. The discussion surrounding natural gas storage was arguably the most intense and strategically significant portion of the entire earnings transcript.
Which is funny, right? Because natural gas storage sounds like the most mundane infrastructure imaginable.
It sounds incredibly boring.
You are essentially just talking about pumping gas into a hole in the ground and leaving it there. Yet it dominated the analyst Q&A session.
It dominated because of a deeply concerning statistical reality. Over the last 10 years, the ratio of natural gas storage to actual production and demand in the United States has been slashed in half.
Wait, cut in half.
Half. The industry has dramatically increased the amount of gas it produces, and the power grid has dramatically increased the amount of gas it consumes.
But the storage hasn't grown.
Exactly. The physical infrastructure required to stockpile that gas has not kept pace at all.
And I guess the physical mechanics of storing natural gas sort of dictate why it's so hard to build. You can't just build a steel tank large enough to hold billions of cubic feet of gas above ground.
No, it would be the size of a city.
Right. So the industry relies on geological formations. They pump water deep underground into massive salt beds to dissolve the salt, and then they extract the brine,
leaving a literal cathedral-sized cavern perfectly sealed by the remaining salt.
Or they utilize completely depleted oil and gas reservoirs. But finding the right geology right next to the major pipeline arteries is incredibly difficult and expensive.
And while the storage capacity basically stagnated, the demand profile for natural gas became incredibly, to use the executive's exact term, peaky.
Peaky demand.
Yeah. The daily demand no longer looks like a smooth, predictable curve. It looks like a heart monitor with violent, massive spikes.
And that peaky demand is a direct result of how we have re-engineered the power grid over the last decade. We have integrated massive amounts of intermittent renewable energy like wind and solar.
Right.
But those sources are entirely dependent on the weather. So when a brutal summer heat wave settles over the Midwest, air conditioning demand skyrockets. If the wind suddenly stops blowing during that heat wave,
the grid operators panic.
They have to replace hundreds of megawatts of lost wind power instantaneously to prevent cascading blackouts.
And the only power plants capable of ramping up from 0 to maximum output in a matter of minutes are natural gas peaker plants.
But a peaker plant is entirely useless if the fuel isn't waiting immediately outside the gate.
Exactly. If a massive winter storm hits and freezes the wellheads down in Texas, shutting off the supply of new gas, the pipelines lose pressure.
And without massive volumes of local underground storage to draw from, the gas never reaches the power plant, the turbine stops spinning, and the grid literally fails.
So storage has evolved from this boring logistical buffer into the ultimate insurance policy against catastrophic grid failure.
It's an existential necessity now.
And that fear of the dark has fundamentally altered Enbridge's contracting landscape. This is huge for the stock.
Talk tickers, bottom line right here. What's the shift?
Historically, utility customers would sign short-term, maybe seasonal contracts for storage just to smooth out their winter heating needs.
Right.
Now, the executives are seeing customers aggressively locking in binding 10-year commitments.
10 years.
The Aitken Creek facility up in British Columbia was highlighted as a prime example of this. Customers are so terrified of being caught short during a peak demand event, they are willing to pay a massive premium to guarantee a decade of absolute security.
And Enbridge is capitalizing on this fear by advancing over $10 billion of near-term growth opportunities strictly within their gas transmission and storage portfolio.
$10 billion. They're deploying massive capital across several really strategic geographies right now.
Let's run through them. Down on the Gulf Coast, they sanctioned the Palacios expansion. That's a $400 million investment, adding 25 billion cubic feet of cavern storage by 2028.
Massive. And in the Midwest, they are expanding the Vector pipeline to push an additional 400 million cubic feet a day westbound, specifically to feed those industrial demand centers.
And up in Canada, they just received regulatory approval for the $4 billion Sunrise expansion.
And the necessity of that Gulf Coast storage expansion, the Tres Palacios one, it is intricately linked to the explosion of the liquefied natural gas, or LNG, export market.
The scale of the LNG market is honestly difficult to fully comprehend.
It's sci-fi level engineering.
The transcript projected that North American LNG liquefaction capacity will require over 30 billion cubic feet of natural gas per day by the year 2030.
30 billion a day.
You were talking about taking 30 billion cubic feet of the gaseous vapor, chilling it to negative 260 degrees Fahrenheit until it physically condenses into a liquid that takes up 600 times less space.
Pumping it onto specialized cryogenic ships and doing that every single day.
It's wild. And those liquefaction facilities on the coast, they cannot tolerate a disruption in their feed gas. They must run continuously.
And here is the actionable takeaway for investors. Enbridge currently serves 100% of the operating LNG facilities on the U.S. Gulf Coast. 100%.
A total monopoly on the feed gas.
Every drop of LNG leaving those terminals relies on Enbridge's pipeline network to deliver the gas from the Permian or the Haynesville basins directly to the chillers.
And they are also replicating that exact model on the Canadian West Coast by advancing the wood fiber LNG project in British Columbia, connecting Western Canadian gas directly to the Asian markets.
It's a juggernaut.
Okay, so we have established that natural gas demand is spiking to stabilize the fragile power grid and to feed the voracious export terminals. But what exactly is driving the massive new baseline demand for domestic electricity?
Which brings us to the renewable power segment.
And the most unexpected driver of heavy industrial infrastructure in the modern era, the artificial intelligence revolution.
The collision of Silicon Valley software ambitions with the hard realities of heavy energy infrastructure is undoubtedly the defining narrative shift of this entire earnings call.
It really was. CEO Greg Ebel delivered a quote during the call that completely reframes how we should view the tech industry right now. He said, quote, "No one's talking about the color of electrons. The number one thing that prevents AI from progressing further isn't GPU architecture, it's really access to energy."
That statement marks a profound, almost tectonic shift in corporate priorities.
How so?
For the past half-decade, the conversation in the tech sector was completely dominated by ESG goals, environmental, social, and governance.
Right. Everyone wanted to be green.
It was entirely about sourcing quote-unquote green electrons from renewable sources rather than brown electrons from coal or gas. But the sheer computational brute force required to train large language models is so staggering that the conversation has basically devolved into a pure energy arms race.
They just need power, period. Doesn't matter where it comes from.
Exactly.
Because we are heavily conditioned to view artificial intelligence as this ethereal software product. We think of code, neural network algorithms, cloud computing.
We think of it as virtual.
Right. But the cloud is anchored firmly to the ground. AI is a heavy industrial manufacturing process. A standard Google search requires a tiny fraction of a watt hour. But generating an AI image or processing a complex AI prompt, that requires 10 to 50 times more electricity.
And when you scale that up to the data centers required to train these models, you are talking about massive warehouses packed with tens of thousands of specialized graphics processing units running at maximum capacity 247.
And those chips generate immense heat.
Unbelievable heat, which requires massive industrial liquid cooling systems and heavy HVAC infrastructure just to keep the servers from literally melting.
So you are no longer measuring power in megawatts, you're measuring it in gigawatts.
Right.
The primary bottleneck for the major tech companies is no longer hiring software engineers. It's not even securing allocation of the latest NVIDIA silicon. It is finding a utility company that can actually secure the land, the permits, and the transmission lines to plug their data centers in.
And this is exactly where Enbridge's rapidly expanding partnership with Meta, Facebook's parent company, becomes incredibly strategic.
Because Meta still has those ESG goals, right?
Yes, Meta has maintained their public commitment to being a net zero company, fully powered by renewable energy by 2030, so they are caught in a vice.
They must train their AI models to survive the tech arms race, but they must also hit their climate targets.
Exactly. And their solution is to bypass the congested, slow public grid entirely and partner directly with an infrastructure giant like Enbridge.
Meta has contracted with Enbridge to physically build the renewable generation required to power their servers. This partnership now encompasses over 1 gigawatt of power generation.
And just to anchor that number for our listeners, 1 gigawatt is roughly the equivalent of the maximum output of a large nuclear reactor. Wow.
It's capable of powering hundreds of thousands of residential homes, all for Meta's servers.
And the latest manifestation of that partnership is the newly sanctioned Cone onshore wind project in Texas.
Yeah, let's talk about Cone.
This is a $700 million capital investment by Enbridge. It's expected to be in service by the end of 2027.
So Enbridge fronts the capital, they manage the ridiculously complex construction and supply chain logistics for the wind turbines, and Meta basically signs a long-term power purchase agreement guaranteeing they will buy every single electron that farm produces.
Wait, that's just the pipeline model again.
Exactly. It is the exact same toll road financial model they use for their oil pipelines, just perfectly transposed onto wind energy.
That's brilliant. Enbridge also discussed their broader renewables pipeline on the call, highlighting the Sequoia Solar Project. That's a massive 815 megawatt facility where half the panels are already installed and generating revenue.
But the true strategic advantage Enbridge possesses in this AI energy race, the real secret weapon, is their portfolio of what they call safe harbored projects. Yes, the executives mentioned they have 1.5 gigawatts of safe harbored renewable projects just waiting in the wings.
And the mechanics of safe harboring are an absolute masterclass in navigating the federal tax code and regulatory bureaucracy.
Break that down for us. What does safe harbor mean?
To understand it, you have to look at how the government actually incentivizes renewable energy. They use production tax credits and investment tax credits.
Right, federal subsidies.
But these federal credits often have really strict expiration dates or phase-down schedules based on exactly when a project begins construction.
And a company like Enbridge obviously doesn't want to lose those massive tax credits while they wait years for a tech company to finally sign a contract.
Exactly. So the IRS allows them to safe harbor the project by either spending a minimum percentage, usually around 5% of the total project cost up front,
Okay.
or by taking physical delivery of significant components like the massive transformers or the actual turbine blades.
So by purchasing that equipment and just storing it in a warehouse, or by completing the grueling multi-year process of securing the land rights, the environmental permits, and the grid interconnection queue positions, Enbridge effectively locks the project in time.
Yes. They freeze the tax credits at their absolute maximum value, and they complete the agonizing bureaucratic friction of pre-construction.
They essentially put a fully permitted, tax-advantaged power plant on a shelf.
Exactly like putting a pre-approved house in a warehouse.
So when a hyperscaler like Meta or Amazon suddenly realizes, oh man, we need 500 megawatts of clean power in Texas immediately to launch a new data center, Enbridge doesn't have to start a 5-year permitting odyssey.
Nope. They pull the safe harbored project off the shelf and they can literally start pouring concrete the next day.
It allows them to deploy capital at the exact velocity that the tech sector demands.
It's a massive competitive advantage. However, it is vital to remember that building physical infrastructure in the real world, regardless of how well capitalized you are or how many safe harbor loopholes you use, it involves grinding, relentless friction.
Which moves us into the final reality check of this earnings call. The legal, regulatory, and financial hurdles of actually moving dirt in North America today.
Yeah, it's not all spreadsheets and gigawatts.
No. And there is no clearer example of this friction than the ongoing saga of Line 5.
Line 5 is a legacy pipeline system. It's a vital energy artery for the Great Lakes region, moving light crude and natural gas liquids from Western Canada through Wisconsin and Michigan down to refineries in the U.S. and Ontario.
Right. And over the last several years, it has become the focal point of intense legal, political, and environmental scrutiny.
Now, keeping our strictly impartial lens here, looking strictly at the mechanics of the infrastructure and the regulatory framework, Enbridge is currently executing 2 massive relocation efforts at the industry's expense to ensure the uninterrupted flow of energy through this corridor.
Let's start with the first one, the Wisconsin relocation. Local governments and Native American tribes raised jurisdictional and environmental concerns regarding the pipeline's path through the Bad River Reservation.
So in response to that, Enbridge is engineering a 41-mile reroute specifically designed to completely bypass the reservation lands.
The financial cost of routing 41 miles of pipe around a specific geography is staggering. The transcript reveals the cost of this Wisconsin reroute is approaching $900 million.
Almost $1 billion for 41 miles.
But the most revealing metric regarding the friction of modern infrastructure development is how that money is actually being spent.
Yeah, this part blew my mind. The executive noted that approximately $300 million of that $900 million total has already been incurred over the last 6 years.
And that capital was not spent on procuring steel pipe or excavating trenches or paying welders.
No, a third of $1 billion was spent purely on soft costs before a single shovel even hit the dirt.
That money goes toward immense legal fees, exhaustive tribal engagement and negotiations, and the creation of federal environmental impact statements.
Right, and EIS, which requires hiring absolute armies of hydrologists, biologists, and engineers to model every conceivable impact the construction might have on local watersheds and wildlife.
Over thousands of pages of documentation.
It's a bureaucratic mountain, and that is just the Wisconsin portion.
Right. The second major relocation effort is the Michigan Tunnel Project. Line 5 currently runs along the lake bed of the Straits of Mackinac. That's the waterway connecting Lake Michigan and Lake Huron.
And to eliminate the risk of, say, a ship's anchor striking the exposed pipeline or a potential leak into the Great Lakes ecosystem, Enbridge has committed to an extraordinary engineering solution.
They are boring a massive concrete-lined subterranean tunnel deep beneath the bedrock of the lake bed to permanently house a new segment of the pipeline.
The engineering complexity of utilizing a massive tunnel boring machine beneath a Great Lake, it's matched only by the regulatory complexity.
Seriously. The transcript noted that while progress is being made, the project is still pending crucial state and federal permits, pushing the target completion date well into the early 2030s.
So when you look at the sheer scale of those expenses, approaching $1 billion for a 41-mile detour and untold billions for a subterranean tunnel beneath a lake, the immediate question for an investor is how a private corporation absorbs that level of localized friction without facing financial ruin.
It sounds like it would destroy their balance sheet.
It does.
Yeah.
But the answer lies in the fundamental financial architecture of regulated utilities, specifically the concept of the financial shield provided by rate-based investments.
Explain the financial shield, because this is crucial for the stock's safety.
Okay, so Line 5 is not a speculative venture. It is a highly regulated essential utility corridor.
Okay.
Because it is an essential utility, the regulatory bodies, the utility commissions, operate under a regulatory compact. The company is mandated to operate the system safely and reliably. In return for that mandate, the capital expenditures required to maintain that safety, including massive relocations mandated by local governments, are considered eligible rate-based investments.
So Enbridge does not just eat those relocation costs out of their corporate profits.
Exactly. The Regulatory Commission allows Enbridge to add that $900 million capital expense to their official rate base.
And then what?
They are then legally permitted to recover those costs, plus a regulated rate of return, by passing them on to the shippers, the actual oil companies, utilizing the pipeline through increased tolls over decades. The shippers pay a slightly higher fee per barrel to traverse the system, which slowly amortizes the cost of the reroute. So the friction is incredibly expensive for the end user of the energy, but the regulated business model entirely shields Enbridge's bottom line.
They pass the buck, legally and systematically.
That's the magic of the coal road.
And the mechanism by which a utility officially updates those tolls is called a rate case, right? Which perfectly transitions us to the final piece of the puzzle from the transcript, the gas distribution segment and the Ohio rate case.
Yeah, Enbridge formally filed a new rate case for their utility, Enbridge Gas Ohio, on December 31st, 2025. And those new rates are expected to take effect in 2027.
What exactly happens during a rate case?
A rate case is essentially a massive, highly scrutinized legal proceeding. The utility opens its books to the state regulators to prove that the baseline cost of providing service has structurally increased, necessitating a hike in consumer billing rates.
And the executive handling this segment, Michelle, broke down exactly why they needed to initiate this process in Ohio right now.
The primary driver is the new macroeconomic reality of the debt markets.
Interest rates.
Exactly. Utilities finance their massive infrastructure upgrades through corporate debt. Over the last few years, interest rates have moved materially higher. The utility must recover the increased cost of servicing that debt from the ratepayer.
And furthermore, they also have to recover the massive capital they have deployed into their pipeline integrity programs, right?
Oh, yeah. Safety isn't cheap. Maintaining an aging natural gas distribution grid requires constant investment.
I mean, they run highly advanced robotic sensors known as smart pigs through the gas lines.
I always love that term, smart pigs.
Yeah. They run them through to detect microscopic corrosion or metallurgical fatigue in the steel.
And they install cathartic protection systems to prevent the steel pipes from rusting in the damp soil.
And all of those safety upgrades require millions of dollars in capital expenditure. The rate case is basically the legal mechanism to adjust the monthly customer bill to reflect the true current cost of maintaining a safe and reliable grid.
So when you step back and synthesize the massive journey we have just taken through this single earnings transcript, the true scale of Enbridge's operation becomes really apparent.
It's awe-inspiring, honestly. We started by analyzing how military conflicts in the Middle East and the closure of global shipping lanes are causing international buyers to scramble for the security of U.S. Gulf Coast oil exports.
Exports that Enbridge has perfectly positioned its Gray Oak and Ingleside infrastructure to completely dominate.
Right. And then we explored how a decade-long structural deficit in natural gas storage has collided violently with the realities of a fragile, weather-dependent power grid.
A collision that has transformed, mundane subterranean salt caverns into hyper-valuable long-term assets secured by decade-long contracts.
And finally, we tracked how the explosive, unprecedented computational demands of the artificial intelligence revolution are forcing software giants like Meta to bypass the public grid.
Partnering directly with Enbridge to physically construct the massive wind farms required to keep their data centers from going dark.
The overarching takeaway from this business, the real bottom line for Talk Tickers listeners, is deeply ironic.
How?
Because Enbridge operates what is fundamentally an incredibly boring, predictable, highly regulated toll road business model.
True.
They just lay steel in the ground and charge a fee for volume. Yet, because of the inescapable physical realities of how energy actually moves, that boring model is currently sitting at the exact turbulent intersection of the world's most exciting and volatile macroeconomic trends.
Global geopolitics, the vulnerability of the green energy transition, and the sheer brute force power requirements of the AI boom.
It fundamentally changes how you look at the landscape around you, which leaves us with a final provocative thought for you to consider.
Lay it on them.
We are heavily conditioned to think of the future strictly in terms of software, data architecture, and virtual realities, right?
Yeah, the cloud.
But if the primary bottleneck for the advancement of artificial intelligence is no longer lines of code or the microscopic architecture of silicon chips,
if the true bottleneck is the physical generation and transmission of industrial-scale electricity.
Exactly. Will the next great geopolitical arms race be fought not over access to data or talent, but over the physical, concrete, and steel infrastructure required to keep the servers humming?
When the virtual world demands physical power to exist, the companies that control the steel in the ground and the electrons on the grid hold the literal keys to the future.
Thank you for joining us on this deep dive. Keep questioning the physical world around you, look past the headlines, and we'll catch you on the next one.